How's everybody doing? It is Bob Iuorio from the PureXposure Growth Series, sponsored by the CME Group and E-Trade, and for the first time brought to you by RealDaily.com. I think we need to just kind of get into this. This is our election show, but there's a lot more going on besides the preview to the election. And with me, as always, on pretty much every show we've done recently, is my buddy Scott Bauer, who's the president of Prosper Trading, which I always like to mention. I am actually a subscriber to Prosper's options signals, which I just love. Scotty, these guys have been on absolute fire lately. First of all, you expect that to continue with Prosper Trading? I think you're going to say yes to that.
That's an easy one. Yeah. Thank you for the nice intro. But yeah, for sure. Great market to be trading in, Bob. You know that.
Yeah, and I always want to let everybody know that I am a subscriber. Scotty's not just on here because he's a friend. He's on here because him and his guys, Mike as well, Mike Shore over on your team there, do a really good job. So let's just jump right into it because we had some earnings. And one of the ones that I looked at was Spotify, who had pretty good earnings, pretty poor guidance. And that stock is down in extended hours trading, because we're not open yet. I'm seeing it down almost 5%. What are you looking at here? And let me know if you like trading before earnings, after earnings, or it's a mix of both.
It's definitely a mix of both. I mean, prior to earnings, what you usually get an opportunity to do is trade volatility, because we know that volatility has really expanded going into earnings. And then regardless of the move that you typically see in a stock, up, down, unchanged, volatility is going to collapse. So that typically gives a really good opportunity ahead of earnings. But I also like trading post earnings as well, Bob, because once that news is out, once the volatility is out, and then the stock can really start trading a little bit more on the technicals, it gives opportunity as well. And Spotify is a perfect one to look at here. So they reported, the numbers weren't so bad. Their guidance was real soft. That's why the stock is down here. And the stock is approaching some significant support here. If you look at, where the 50-day moving average, which is an indicator that I, use extensively along with other things, it's coming down right to that area here. So when the market opens here, let's see what happens. I always like to see the stock kind of settle in, see what volatility does, and then react from there. But, I would be leaning right now, if you, at 8:05 Central Time right now, if you said, Scott, what's your move going to be? It would be, something on the bullish side if Spotify hits that level.
So let me ask you, again, looking at Spotify, because like you said, it's pretty close. It's only a few bucks from that 50. In pre-market trading, we've already got the vol on Spotify down almost 18%, according to E-Trade's platform. So when you say vol is going to be moving, do you mean the stock specific, vol in general? Obviously, we had the VIX above 40 yesterday. Tell people which one you're referring to.
Yeah, I was referring more to the option volatility, the implied volatility. So, once the uncertainty of an earnings event is out, or the uncertainty of anything, once that is removed from the marketplace or a particular stock, you see the volatility, whether it's overall market volatility or individual option volatility, really start contracting. So what's going to happen in Spotify is you're going to see the premium levels of individual options really start getting hit. And I would expect them to be about 40% lower than where they were just at the close of the market yesterday.
So as I look at the pre-market on the indexes right now, we've got Dow futures down 6 basis points. For people who don't know what a basis point is, 100 basis points is 1%, just for everybody that doesn't know that. NASDAQ's up 65 basis points, the S&P's up 22, and the Russell is down 18. So all of them were up prior to you and I speaking before the show started. Is it likely or probable or even possible that if the VIX spikes again, which right now we've got the VIX down 87 basis points, it's at about 39.93 on the E-Trade watch list that I'm looking at here. If the VIX spikes again, can the Spotify volumes or volatility still go down?
Absolutely. They're not necessarily correlated hand in hand. If there was not the earnings event in Spotify, you might see a little bit more of a correlation with the VIX. But now that event is over, that's what happens. Much like what we're going to see later today. That all the big guys are all reporting after the close today: Apple, Google, Facebook, and we're going to see increased implied volatility, option volatility going in, to the close of the market today. And then regardless of what happens, Bob, whether the stocks are up 5-10%, down 5-10%, whatever happens tomorrow, you will see that volatility come crashing down because the uncertainty, the unknown of this event is now behind us.
You good with looking at Overstock, which also had earnings as I pull up that chart?
Yeah, I loved Overstock. I was on some major financial networks earlier in the week touting this one and looking for a real positive print here. And stock seems to be up, what is it, about 12-13% right now, maybe even a bit more.
Yeah, pre-market, we're looking at 11.84%.
Okay.
That's actually down from being up almost 13%.
Yep.
But it's a big gap open. So what are you looking for here? You said you were on major news day. It's okay to mention which one. We're not competing.
I was on Bloomberg earlier in the week on their
Okay.
options insight with Abigail Doolittle, and
Okay.
I focused in on Overstock and talked about some of the fundamentals of the company, and then an option trade that I would make, and the option trade was just a bullish vertical call spread going into the print here. I always trade spreads, Bob, because I always 100% want it defined by risk. If I'm wrong, which obviously happens all the time, I want to know what my risk is. So I measure the trade based on reward to risk, and I was very bullish. I put out this bullish call spread, and really in this one, even though volatility is going to get crushed this morning, it's not going to affect my trade because the strikes that I use are going to be pretty far in the money.
So if you guys want to see that interview, you can just go to Bloomberg's website, type in Scott Bauer, which is Bauer, and it'll come up as one of the most recent videos to see if he's actually, I know he's telling the truth about it, but so you had a bullish call spread. Let me ask you something. So calls and puts, you're obviously, if you just bought straight calls, you're limiting your risk as well. You always trade call spreads. So is that always when earnings are coming out, or always, and why?
I personally trade spreads all the time because what I do is using math, using the Black-Scholes option pricing model, we can identify what the market at any specific time is predicting the move in a stock to be out to a certain point in time, out to the expiration. And the model, the Black-Scholes trading model, which nobody ever has to really understand the math behind it. You do really need to understand the inputs that go into it. I kind of tell my students, Bob, when talking about the option pricing model, it's like making your smoothie for breakfast in the morning. You know your ingredients that go into the blender. You have no idea what happens while the ingredients are in the blender, and then you get your end product. Same thing here. So when I look at which options to trade, it's all based on this model that's telling me with a, not to get too mathematical here, with a 68% probability or one standard deviation probability, how far the stock is expected to move in either direction. So by using that math, by having a 68% probability in my pocket, I'm able to identify what potentially are ideally the best option strikes to trade.
All right, so let me ask you one more question about this. I've got you for another few minutes. And by the way, if you guys want to type questions into the YouTube comments, we've got people watching that who will try and get the questions to me. So from a perspective of the vol situation, so vol will compress now. Now it'll compress for the call you own and for the call you sold. For anyone who doesn't know what a call spread is, you're buying one closer to at the money and selling one further away from at the money. So vol's compressing in both. Is it more likely, like, do you have to get the strikes right? Do you have to be close? And you can read, God, I forgot the author's name, Option Pricing and Volatility Strategy.
Larry McMillan.
McMillan, that's it. If you want to fall asleep, you can read that book.
Exactly.
Yeah, or you can just call Scott at Prosper. What's like, do you have to get the strikes right? Do you have to get the target right?
You don't need to hit, you don't need to be right. You need to be fairly close because there's two things coming into play here. The delta, which measures the move of your option or measures the move of your spread, and then the volatility. Now, like you said, Bob, in a spread, the volatility is going to affect both options pretty much the same. So as one goes up, the other one's going to go up and vice versa. But the delta or the amount that option is actually tied to the move in the stock is the big differentiator in a situation like that.
All right, where can people find you, Scott, if they need to find you? We're going to come back in a minute with your buddy and mine, Jeff Killburg. But where can people find you if they need to find you?
So I'm CEO of Prosper Trading Academy, prospertrading.com. And, we're out there. We're a education company. We trade along with our students, and we're live every single day, 8:30 to 3 o'clock Central Time in the market. So we are interactive with our students, with our clients all day long.
Real quick, any quick trade you want to look at right now before I let you go and go to Jeff?
Yeah, talk about volatility. I have been, for the most part, a seller of volatility during this, entire, run up to the election here. And I think one to look at would be selling some volatility in the triple Qs going into the big earnings reports at the end of the day today. Again, not necessarily directional, whether you're bullish or bearish on where, the Qs may go based on Amazon and Google and Facebook, but selling the increased volatility, meaning you're able to collect additional premium because of the unknown, because of the earnings report.
All right, we're going to come back with Jeff Killburg after this break. I just want to let people know this is our election show, but because there's earnings right now, that's Scott's specialty. So I want to stick to earnings with Scott. We'll be right back. Scotty, thank you for being here again.
Thanks,
Prosper Trading, if you need to find him. We're going to come back with Jeff Killburg, and then maybe we'll get a little Jeff Killburg and Jim Iuorio on at the same time. Cheers. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
The Superman of KKM Financial.
I wear a lot of hats, Bob. I wear a lot of hats, so I'll take anything, and I've been called worse, so we'll take those names.
Jeff is a really good friend of mine. Jeff and I did a show for the CME for quite a while, hoping to do some more stuff with Jeff. Jeff is CEO, president of KKM Financial. And before I get into what you think about things, Jeff, a lot of people see you on CNBC, virtually almost every day, talking about futures. But that's not really what your company does, is it? And we've got a high net worth audience, so you should speak to them.
So we work with a lot of financial advisors. We work with a lot of family offices. We create, in our minds, very distinct investment solutions. So we run a lot of ETF model portfolios powered by NASDAQ, Dorsey, right? Active, dynamic, 100% systematic. But we also do a lot of custom and bespoke option overlay work. For a lot of folks who have concentrated stock positions, we find a way to provide risk mitigation. We provide a way to find income. So right in the wheelhouse here, Bob, but really a wonderful, despite all the moving parts, despite all the sadness we have in the economy and in real lives, we are enjoying the opportunity from a trading perspective as we really get into just a lot going on and a lot to unpack here, whoever comes in the president for the next 4 years.
Yeah, we probably should touch on that because there's obviously pain out there, but it's not really our job. And it's one of the reasons I like doing this show is because I hope that everybody that's watching understands that we have sympathy and empathy. And I had someone in my own family die of COVID, actually a Chicago police officer. So there's a lot going on, but our job is to make sure people are prepared and understand what's going on from the financial side. So going from that perspective, Europe is locking back down. Illinois locked back down. I left Illinois a few weeks ago, and I'm down here in Florida now permanently. But I am looking at these things with great interest because my family's down there. My brother's in the restaurant business. My brother-in-law has a barbershop, which might have to shut down. And I'm trying to understand with the election coming up, Jeff, what somebody like you is doing for clients. Again, you work with financial advisor, family offices, a lot of high net worth. We have financial advisors I know that watch this show. So what's your sort of plan for the election? What do you think is going to happen? Blue wave, blue president, red surprise, whatever it is.
Well, look, for no doubt about it, it's interesting to see. Historically speaking, Bob, we look at all the different elections, and every 4 years, this election is the most important election of our life. I'm not diminishing that by any means, but historically speaking, the actual election, whoever's in the president, whoever's in the White House for the next 4 years, is not as significant as where the overall market trajectory is. So we continue to be optimistic, continue to be bullish, but inside of this week, and what is this week? I know we're in this election days where everyone's trying to figure out who's going to win. Polls are telling us one thing. We don't trust polls anymore. And we're trying to do what can we do if we get upset. Now, of course, upset is different to everyone who's watching, contingent on who actually wins. But one of the things that we go back to is our Essential 40 portfolio. And this has really been significant. And we talk about the names that you want to own moving forward. So let's break that down and unpack that just a little bit. Some of these names, look at the high flyers this year. In our Essential 40, we have FedEx, we have Amazon, we have Apple, we have Facebook, we have Microsoft. And obviously FedEx is up to most of that, but let's also talk about some of the laggards. We like to pick on our warts. American Airlines, wow, we continue to talk about that, but the airlines, we still deem them as essential. We look at Boeing, look at ExxonMobil, EPD, and Cisco, the food delivery company. These are essential names where we're really trying to understand what companies will be around. In the wake of COVID-19, what companies will be around in a year or two, and more importantly, which of those companies will have pricing power. So when we focus on these names, these are tangible names. These are names that we utilize and we deem critical to the U.S. economy and the American way of life. But here's an opportunity. Let's look at today. I get so excited. I'll be on CNBC here in a little bit talking about what we're doing in earnings season, but there's 180 companies. 180 companies. This is the heart of earnings season. Today's like the Super Bowl, Bob. You know, we're so excited because we have the 4 big tech names, and everyone talks about these FANG stocks. Facebook, Amazon, Apple, Netflix, and Google. But let's take out Netflix and let's bring in Microsoft. But today, after the bell, within about 30 minutes, it's a little 30 lot for some of you folks who remember those hand signals in the pit, 30 minutes, we will see all these reports. So I think today provides an opportunity. If you have exposure to these names, which everyone does, if you want additional exposure to these names, here's an opportunity to sell puts. Look at where the volatility levels are. You are being paid handsomely to collect any type of put selling. If you have a little risk mitigation, you're concerned about the bigger picture, talk about these lockdowns, and maybe there's some put spread opportunities. But we look at really getting an opportunity today in the action to see what this afternoon looks like. Because I do believe we're going to go back to earnings matter. Right now, earnings don't matter.
So a couple of things. Again, questions are open if you have a question for Jeff. Actually, if anyone gets a good question, and I'll send you a stack of these. These are, Jeff recognizes these because he just did the 30 lot. These are authentic trading cards traded by Lazar Printing, or printed by Lazar Printing in Chicago, which is where we used to get them all. So you talked about your essential 40, right?
Essential 40, yes.
Okay, so you mentioned some companies that are in there, and the one that jumped out at me was Exxon, because if you look at energy, it hasn't done well. But what you're saying, and correct me if I'm wrong, and by the way, this is also for you, Jeff. I have an espresso here. Yeah.
Oh, thank you.
If you're correct, you're focusing on companies, and it sounds like stuff that we do in our core portfolio in the stock think tank, companies that actually make money, that have revenue, not necessarily a Snap, for example. You're talking about core companies.
Correct.
So even though energy's beat up, you're good with something like Exxon.
An Exxon or even a Chevron, you look at a name like this, Bob, we're talking about a market cap of 133 billion. We're talking about actual revenue of 213 billion. So of course we're seeing energy absolutely get decimated. The worst sector in the S&P 500. We're seeing financials just to tick above, but there are some core holdings here. We will see a resurgence. We will see consolidation. And a name like Exxon, I've owned, but we have a covered call strategy on top of it, but also down here, we are able to sell puts. We want to add exposure to this, despite the fact it's down. ExxonMobil is down 35%. Absolutely cream cracker.
Yeah, certainly hasn't. The dividend hasn't made up for that. capital
Correct.
depreciation. You also mentioned selling puts. That's something you want to do in case what happens? Because the volatility is high. You obviously think, as I do, that equities have a natural upward bias in the US. They're going to go back up at some point, but you need to take advantage of times like this to generate alpha, to catch up. What is it?
Well, I think it's a combination of understanding the volatility environment we're in. With the VIX at 40, that's historically about 3x of where we typically are in a vol regime. So right now, we're seeing emotions high. We're a week out from the election, but this provides opportunity for premiums to be very elevated. So by selling that option premium, of course, you have to be comfortable in owning ExxonMobil or whatever name you're potentially selling puts. But if you're selling those at the money puts, you have to understand what you're collecting. You subtract that. That's your actual cost basis, because you may have the opportunity to be prepared for that cash commitment to that actual name. And then what we typically like to do is, if we do see a little bit of a bounce after being put to a name, then we'll write a covered call. And now all of a sudden we have an income stream. So we're always trying to capture. And of course, sometimes we're selling option premiums, Bob. Sometimes we're buying option premiums, contingent upon the volatility in our model being expensive or inexpensive.
You're an ETF guy, Jeff, and I've got a question here from Dan. Dan said, I hope I'm not putting you on the spot with this one, but I know you can handle it. You've been in several high pressure games when you played football at Notre Dame. I need to mention that because you didn't, which is weird. If you had if you had one ETF you wanted to buy now, potentially hold for 6 months past the election, again, this question from Dan, one ETF, can you pinpoint one? And if you can't, just say that. I mean, I'm not trying to put you on the spot.
No, we're in, baby. So we run models powered by NASDAQ, Dorsey, right? So that truly is a technical approach to portfolio construct. IYT, that's the transportation ETF. We just saw IYT come into our models. We've owned FedEx in the Essential 40. And if you think about FedEx is a great example, or UPS, any of these names. In the month of March, those were names that were left for dead. No one thought that those companies were going to exist. Here they are with contactless approaches. We're seeing that. So IYT, Norfolk Southern, Union Pacific, Kansas City, Southern, all these different names, I think, has the ability to move higher. So IYT, I'm going to sneak one in, a little bonus ball here. We still like software. IGV, we still like software. Microsoft, Adobe, Salesforce. We just upgraded our package on Salesforce. Oracle, ServiceNow. These are all companies that are going to continue to attract assets in the wake of COVID-19 or this new economy we live in.
So IYT, IGV. Jeff, thank you for that question, Dan. Jeff, where can people reach you if they'd like to? They got you on Twitter. You want to give out an email? You want to give a website? Whatever you want.
Yeah, absolutely. At Jeff Killburg is the Twitter. info@kkmfinancial.com. We can get an answer, or go to our website, kkmmodels.com. That is purely trading. There's no pictures of beautiful women there, Bob. It's kkmmodels.com or kkmfinancial.com. You can access us. We'd be happy to have any conversation or answer any questions.
I think I'm getting typecast. So I wanted to keep you on through the commercial with Jimmy, but we're having technical problems. I can't. So you got a message for Jim Iuorio before I let you go?
You know, tell Jimmy to stop flip-flopping. Give us a real answer. Tell him I love him, first and foremost. Tell him I love him. But second of all, I don't want to hear a long-winded story. Just give us the answer. What is it, Jimmy? Buy or sell? Come on, pal.
Jeff, thanks again for being here, buddy. We're going to be right back. We are sponsored by the CME Group and E-Trade. We are brought to you by Real Daily. We'll be back after this message. Jeff, thank you. Everybody, go look for Jeff if you need him.
Thank you, Bob.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Jimmy, I got to have you say that again. Jimmy was just asking me if I'm in Florida, which I am. And your comment was, Jim?
I said, I want to move to Florida, but my wife wants to stay here. So we compromise and stay here. That's the way it works in my relationship.
Jim Iuorio, Managing Director, TJM Institutional Services. We are back with you. This is our election show. But first, I got to give you a message from your friend of mine, Jeff Killburg, who basically said, first of all, he loves you. But second of all, stop flip-flopping. Is it buy or sell? Just give us an answer. Just tell us what
Jeff,
it is.
Is that the Jeff
Stop
Killburg who went to Notre Dame?
flip-flopping.
Is that the guy? The one who went to Notre Dame?
You know what? I gave him an opportunity to mention that he's been in high-pressure situations in games when he played football at Notre Dame. But he didn't mention it, which I was floored by that.
Wow.
Absolutely floored by that. Jimmy, thank you again for being here. And before I start, I want to plug that there is going to be a Jim Iuorio Futures show that we're going to be hosting and sponsoring. Everybody check your emails, watch Jim's social media for that. So before we start, give out your social media real quick, Jimmy.
At Twitter, it's at Jim Iuorio. That's Jim, of course, Iuorio.
All right, so I'm volunteering to be the first guest. I don't know if he's going to take me up on that. It's going to be a half-an-hour futures-specific show. I think we'll get CME to sponsor it. I don't want to commit them yet, but either way, we're going to be mentioning them a lot. So this is our election show. Obviously, there's a lot going on this morning, actually the last couple of days. So give me your opinion of the sell-off. As I sit here right now, cash is about to open, but the futures, we've got the VIX down 74 basis points. We got the S&P futures are up 15, NASDAQ up 56 basis points, Dow down 6, Russell down 31. What do you think?
Well, when you consider the magnitude of yesterday's down move, today's up moves are uninspiring. We're 3 or 4 days by one of the big in front of one of the biggest binary events. We have plenty of things to worry about. I think people are worried about the talk of phase 2 or 3, however you're counting, of the virus's resurgence and shutdowns. The economic impact is what I'm talking about more so than the virus itself.
Right.
There is worry now of a contested election. I'm hearing other people worry that if the Democrats win, that perhaps, because in my mind, the election being over made the stimulus package, the impediment to the stimulus being passed would be gone. But now the worry is that does the losing side worry that the winning side is going to get credit if it's passed? I don't know. I don't believe that, but I think the market's got a lot of things to worry about is my point. I think at the end of the day and at the end of the election, the reality is that we still have a government and a Fed that's willing to throw absolutely everything at this. And regardless of who wins, because everyone's like, well, if the Democrats win, maybe they'll have extra regulations on corporations, but they'll spend a crap ton of money. And I believe that that's the truth. But if the Republicans win, they won't spend probably as much money, but they'll probably be less regulatory on corporations. So either way, it could be a recipe for stocks going higher. We have to go through this period of worry right now, which I think is actually valid, and it's shaking out some week longs. But it doesn't shake me from being a bull. And it's not the wonderful kind of bull like everything's going to be great. It's everything might be great, and if it's not, there's still the government's at the ready to support it.
So my theory is currently that blue wave, larger stimulus, probably in February, but probably faster than if the Senate stays red and the president stays red. Probably get a huge package faster, but the economic bill comes due a lot quicker. So you might be looking at a situation where the market rallies maybe in Q1 of next year, Q2 of next year, and then starts to realize that a bill is going to come due to the economy for this 1 billion trillion package or whatever size it's going to be. If we get a red surprise in terms of the president winning and the Republicans keeping the Senate, maybe a smaller package, maybe even quicker, because now the Democrats want to get right into the next election. I'm not making political statements, by the way. This is just my theory. And then if it's blue president, red Senate, we probably get a small deal and then another small deal. What are your thoughts on that in terms of my theory? Do you think that's right? And give me your market scenarios for that.
I like every bit of that. I think I'm going to break with what some of the narratives were. I think that if we do get a blue wave, I think there's some fear in that because there's definitely higher taxes coming to that, particularly corporate taxes. So I think there will be a period where they have to commit to this spending that we assume they're going to do. And I believe they will commit to that for sure. And I like your notion that as they do commit to that, that is a good short-term boost for the market, maybe a couple quarters. Longer term, again, I fully believe, and this is not a political thing too, because I'm mixed politically a lot, but when it comes to the corporate sector, you cannot convince me that someone coming in that is planning on reining in corporate excess, raising corporate taxes, raising regulation, and that's not something I'm saying. That's what they run on oftentimes. I don't believe that as a long-term recipe for good growth. I believe it could be for growth, but that's going to be growth at deficit spending. And this new notion of modern monetary theory, I don't know if you've read the book, The Deficit Myth yet, by Stephanie Kelton. It is absolutely terrifying, because the belief is that we can run up debts to $100 trillion, and we should run up those debts to support people. And that's all well and good until the moment it's not all well and good. And history is littered with people who've been cavalier with currency policies.
I asked a very smart question, very smart person that question. And I said, what's the next step on that? And he goes, well, you see it with Japan. And my contention was, you don't see it with Japan, because Japan was the only country doing it. They did it for basically 25, 26 years, but they were the only country doing it. Now we have almost every country doing it. The US is kind of held back a little bit. And as of right now, is the press conference now? The press conference is now. The ECB left everything unchanged, but there's a press conference going on right as we speak. So if the EU joins in and says they're going to increase asset purchases, that's now the second to the last block of countries that is not doing MMT, in my opinion. And if the US does it, you've got the reserve currency doing it. And that, to me, is where I see the problem. Again, our job is not to say what's right or wrong.
Right.
It's to say what's going to happen in the market. So that's the economic bill I think is going to come due. So based on that, I'm either right or wrong in your view, and you have a trade we need to talk about. So I want to get to that, because you have to tell me what that trade is.
Sure. And I think you're absolutely right. But the timing on you being absolutely right could be, 6 months, 2 years, 10 years, 15 years. So that's folly in some ways for us to beat that right now, because we have to talk about what's going to happen in the next couple of weeks. And here's a trade that I have on, and this is it's mildly complicated. We've talked about trades like this in your show before, and the reason I stay with them is because they've been working beautifully for me. Volatility is through the roof right now, so you don't want to just go out and buy a call or put it. Again, I'm not recommending anything. I'm telling people what I do. I have no idea what people's risk tolerance is, et cetera. But anyway, so I bought a week 1 November, 33.25, 33.75, 34.10 broken call fly for 9 ticks. Now, it's much more simple than it sounds. This gets you to November 6th, which is Friday after the election. It was diagrammed that way on purpose. So you're buying the 50 wide 33.25, 33.75 call spread. So you own that 50 wide call spread. And now you sell the 33.75, 34.10, 35 wide call spread to help you finance that. Basically, what you're doing is you're buying this 33.25 call, you're selling another call here, and then selling another call spread to even make it cheaper. You get that for 9 ticks, so you risk $450 to make a potential $2,050 if you nail it at 33.75. Spoiler alert: you're not going to nail it at 33.75. Nobody takes off flies on the nose. The reason it's a broken fly is that if this market flies higher on some relief after the election, I don't want to lose everything I put in. So if it flies higher above all the strikes, it still ends up being worth 15 ticks. And as it moves past that middle strike and your 50 tick one starts to fill out, your 35 tick won't fill out nearly as fast. So you have some room on the upside to make money on. Did I explain it okay, or do I have to go in deeper?
No, I think you did. And this is part of the reason that we want to do the Jimmy Iuorio Future Show, is so that you can actually go into detail with diagrams showing on the E-Trade platform or wherever else we're going to show it, the CME's website, how these things diagram out. And so from a perspective of, if it blows out to the upside, you're looking at about 1 3/4 to 1 reward to risk on this. If you hit it right on the money, which again, nobody ever does. If you have the S&P actually expire on November 6th at 33.75, I'm going to come and kiss you on the lips. I don't know if you'll accept that.
Not in these troubled times of COVID. As soon as it's over, lip kiss is fine.
Well, I'm just saying that this is why we want to do that show. Okay. So that you can go into these, because I think the last 4 shows, you've been right. The last 4 shows you trade have been right. And I love the idea that this goes 3 days past the election, because it incorporates a couple of days of potential disruption. And if the market falls, $450.
Right. That's it.
Okay.
That's it. To sleep at night. And I find I trade so much better when I define my risks, and I sleep so much better when I define my risk and not have to worry about. I sold these 3x5 put spreads a couple months ago, and all of a sudden the worst possible scenario started happening. And I then turned into a moron trader because I was looking at the possibility of losing tons and tons of money. By the way, I can swear on this show, right? This is more like a trading floor.
It's a regular trading floor show.
Okay, so knowing that going forward, I'll describe it the way I would normally describe it. But those were some bad nights of sleep and some bad trading when all of a sudden I didn't define my risks and it started blowing up in my face.
Yeah. Jimmy, tell everyone where they can find you again. And then I'm going to talk again about watch your email inboxes if you've signed up for our email list. Otherwise, check out Jimmy's social media, check out PureXposure's social media and mine. Jimmy, where can they find you again on social media?
Twitter, it's at Jim Iuorio, JIMIUORIO. Today, I've been tweeting a little bit about a potential euro short position that I'm looking at. So if anyone's interested in that, we can have a conversation. The currency.
Okay. Guys, thanks. Jimmy, thanks for being on again. Again, we're launching a Jim Iuorio exclusive future show. He's the host of it, not me. I've offered to be a guest. I'm sure he's going to say no.
No, I'm just not going to have guests. I'm just going to talk nonstop for a half hour.
Please have Killburg on once. Just have him on once.
Maybe. And then just not let him talk. That would be perfect.
Yeah, just mute him every time he tries to talk about Notre Dame.
Sorry, Jeff.
Jimmy, thank you for being here. We're going to be back in a few minutes. Again, this is PureXposure Growth Series, sponsored by the CME Group and E-Trade, brought to you by RealDaily.com. We're going to come back with Mike Arnold. Mike's got some great charts, and he's the best chartist out there. Stick with us.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back with Mike Arnold, who I was actually going to describe. I put together a stock report that you guys can get at the stockthinktank.com. It's a free report, 3 stocks plus 2 bonus stocks. And in the body of that, I almost put my lifelong partner, Mike Arnold. And then I thought that sounded weird. So I reworded that to my co-portfolio manager of the Stock Think Tank and the chief technical officer of Path Trading Partners, Mike Arnold, is here. Mike, I want to get into your charts because you sent some great charts. But first, give me an opinion of what you see happening right now in the equity markets, because I think that's important to people. As I speak to you right now, the cash is now finally open. The Dow is down, the NASDAQ is up, the Russell and the S&P are both down. The Dow's down 0.75 point. Do I see that right? Is the S&P down 3%?
Yeah, let's see. The S&P is down, what, 0.3% right now.
Wow.
0.3. It's not down 3%. It's just down. It's heading lower, though. We're getting a lot of selling pressure in here. Still, it could not sustain a rally yet.
All right. So talk about what you're seeing in those 3 indices. The Russell, you could chime in if you want. I don't see anything there, but what do you got in those 3 indices before we pull up the charts? We can pull the charts up after you just give us broad strokes.
Well, interesting enough, we have some massive double top potential reversal patterns. Now, one's confirmed in the Dow. That's the only one that's confirmed. It almost triggered yesterday in the futures on a daily basis. I'm watching for a weekly basis, but every time we seem to get a little rally going, it's attracting a lot of selling. So, and another thing that's interesting, and you mentioned the stock think tank, which we're actually very under allocated going into this, and that was not intentional. What we were finding is every potential trade we were working on, the reward to risk ratio was not favorable. So we couldn't actually get in the trades at a proper level to justify the reward to risk ratio. So naturally, we're under 20% allocated going into this major sell-off just because we couldn't find positions that had proper reward to risk.
We did just send out a trade to get into big lots, right? BIG.
Yes, we did send out a big lots, which is pulling back slightly today, but that is held up very, very nicely in the face, especially yesterday. It ended up rallying. The last 2 days with these sell-offs, it's ended up rallying, and it's in a pretty key support area. So we've been interested in big lots for a while, and it just based off of it has good reward to risk, and it's, even though it's pulling back today, it stood up very well in the face of all this selling pressure.
All right, so let's pull up your charts. Which one do you want to look at first? Because I want to pull up the right charts, and I want to talk about it in the context of you sent me weekly charts.
Yes.
All right, so which one do you want to look at first?
Let's pull up the Dow first, because that actually confirmed in the futures yesterday. It did not trigger on a daily basis, which needed a close below the low of, let's see, what was the low price we needed? 26,407. It closed at 26,409. Again, I'm going to reiterate, I'm trading this on a weekly basis, so I need a close going into Friday below that 26,407. Right now, we're trading below it, but again, we still have the rest of today and tomorrow worth trading. But these are massive patterns that, if they triggered, the full target on the Dow could return it to about 23,700.
Yeah, so talk about the color spaces below, because you're going to have those on all three of these charts. What are those?
The colored spaces, the orange goes down to where we would typically, if this triggers, we reduce our stop. So we reduce risk at the orange. Yellow is the first target, red is the second target. So it's a 3-target trade, but only 2 take profits, the yellow and the red.
And the red moving average is what? Is that the 200?
That's the 200-week moving average on those charts.
Okay, so notice something great on this particular chart. The 200-week moving average comes in right around the risk reduction area. So Correct. It actually is a good place to reduce your risk in case the market were to hold up there.
Right, and even if you come down and look at with the Dow with the yellow target, and you go to the left, you see this little prior resistance ledge, and that's the concept that people talk about for a very long time in the markets, which is prior resistance becoming support. So these actually play out very well, and we also have the retracements on there, and I use harmonic retracements. But the 50% retracement of this whole up move from the March 18th lows to the high in September, the 50% retracement actually corresponds with the target, the full target for this huge double top in the Dow.
So that's kind of a confluence there of factors, although we don't increase risk when those confluences appear.
No, it's just interesting when things line up. It doesn't mean it has to trade that way. It doesn't give it any more probabilities. The probabilities are the probabilities, and we'll trade based off those probabilities. I just find it very interesting when things line up, especially with key targets.
Let's get to the next chart, because I don't know if Bill Baruch can hear us. Bill Baruch from Blue Line Futures, Blue Line Capital, and he also has Wealth Management CTA. He's waiting to come on, and I want to make sure I get to these charts because these are weekly charts, so they could encompass the election. What's next, Mike?
Let's just go to the NASDAQ. The NASDAQ's holding up the best. It's nowhere near confirming this. It would need a close on a weekly basis, futures below 10,650, 650. And right now it's trading around 11,225. So it's still holding up quite well, and it's within our weekly rotation zone.
These are the futures you're pointing to here, right? Or the cash?
The futures.
Okay.
So
again, explain those lines.
again, the orange and blue lines, which we're trading between right now, is a concept we have. It's a weekly rotation zone, which is where we look for key support and potential return to up moves. So if you see a few weeks ago, we returned to those weekly rotation zones, that which formed the bottom in this potential double top, and then we rotated back up. We're now in that rotation area. So we will be watching for rotations back up, but the key support level we're watching in there is about 10,900. If we start dropping below 10,900, the weekly rotation zone has been violated, and then we're really going to be focused on that potential double top.
All right, what's the next chart? Is it the Dow?
E-mini, S&P?
We did the S&P, didn't we? Or we did the Dow
No,
first? You're right.
We did the Dow first.
Yeah, so the S&P chart.
So the S&P chart, we're looking at, hold on, there we go. We're trading right now below that weekly rotation zone, 3,198. A close below that would trigger this double top in the S&P. And what's interesting, the full target on that, which is the red line, 2,809, comes in right above the 200-week moving average and at a prior key support level back that was established in April and May.
So again, we have a sort of a confluence of why it would make sense that would be the place that it would go to if it were to break down and be a confirmed weekly double top.
Correct. And though both the NASDAQ and the S&P have not confirmed, the Dow's the only one that's confirmed, and none of them have triggered yet. So these are all potential trades that we're watching. Doesn't mean they'll even take place. We could rally the next couple days. We could rally Friday and close above the key levels, and there is no weekly trade yet.
So before we go to the last chart, if they confirm on Friday, what are your videos over the weekend going to be on the Path Trading Partners YouTube channel?
The videos will be mentioning, and I put this out. I put out a Danger Will Robinson video on Monday this week when we started mapping these out, and these are free videos on YouTube. I put out videos every day covering things, trying to help people learn to trade the markets from a technical basis, putting, I don't know how many years, 28 years of market knowledge into account, because a lot of people just put on positions, don't know how to manage targets, don't know how to manage stops. So we put out this information for free every day, covering stocks, futures, even we cover the cryptos like Bitcoin, which I'm really loving. We put out a video a week and a half ago on Sunday talking about we're watching for a rotation back up, and we got that strong rotation back up, which took us to our key targets right around.
Let's put that chart up. Let's put that chart up before you go into that. We can put up the Bitcoin chart.
Now Bitcoin, I put out a video yesterday talking about this really nice pullback to the daily rotation zone, and that we're watching for a rotation back up. And right now, as we speak, we formed a 1 hour, and I'm watching this on the 4-hour chart, a 4-hour double bottom. We need to get a close above 13,324 to trigger. But if we did get that, then we'd be looking at triggering a double bottom against key support on the daily basis, and we'd be looking for a potential return to about 13,756.
Okay, and those are on the colored lines above. Why are the colored lines above this time? What are these? These extensions, or are these the double?
No, that's the extensions. The double just happened this morning, so that those lines are not on those charts. The targets for the double, I can give them all out. The stop reduction, again, if this is on a close above 13,324 on a 4-hour basis, the targets would be 13,540, 13,648, then 13,756.
If you miss those, there is going to be a replay available. As soon as we're done with the live show, the replay will be there. You'll be able to fast forward to those levels if you need them. Go ahead, Mikey.
And also, I will put out a video later today covering this double. Whether it triggers or not, I will still cover it. So if anybody wants to go to that Path Trading Partners YouTube channel and see exactly what I'm talking about, they can do that.
All right. And where can people find you, whether it be Stock Think Tank, Path Trading? Where can people find you?
They can go to thestockThinkTank.com. They can go to pathtradingpartners.com. They can follow us on Twitter at path_trading. They can email us at support@pathtradingpartners.com. We're out there pretty much.
And again, if you're a stock trader, thestockThinkTank.com is where you can find mine and Mike's portfolio, where you can join and follow what we're doing. And then also, if you're interested in other things, you go to that Path Trading Partners YouTube channel or pathtradingpartners.com. Mike, thank you for being here. We've got one more break we got to throw in here. Then we're going to go to Bill Baruch. Again, Billy covers everything. So I'm going to let him take the show as long as he wants to take it. Stay with us. One more commercial. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We're back with Bill Baruch and Billy, Blue Line Futures, Blue Line Capital, Blue Line CTA, Blue Line Grocery, Blue Line Drugstore. You do everything, man. I mean, it's a pleasure to end the show with you. And we're supposed to end at 10 o'clock Eastern, 9 o'clock Central Time, but you take as much time as you need, want, or have. You are the president of all of the above, but why don't you, since I'm being a little exaggerating a little bit that I tend to do, tell everybody what you do before we get into the markets.
Yeah, it's thanks a lot for having me on. Blue Line Futures, it's our cornerstone business. We're a independent introducing broker. So what we do is we help clients of all shapes and sizes. You know, it's the new traders, novice traders, all the way up to we have professional traders, people that sit and do this for a living. People on the floor of the Chicago Board of Trade, or at least when it was active. So we have a wide range of clients. We help give them clearing solutions. Very flexible rates and commission structures depending on your volume. But also we have in-house research that we put out every single day. It's consistent, it's reliable, breaks down fundamentals, technicals, our proprietary levels, our bias, and help you trade the market. And really, we're not some firm out there that's giving the trade of the day. We're really giving you a full holistic approach to trading. You have to do your own research too, but you lean on what we talk about, and then you have access to our trade desk. So you really get access to the guys that are writing the research. And whether you're a novice guy or someone at the Board of Trade trading on the floor, the levels are consistent. They're there, and you know what to expect each day. So that's where we separate ourselves in the business on the brokerage side. But then also just launched Blue Creek Capital. We're a commodity trading advisor. So we're really what it is. It's a commodity hedge fund is another way to describe it. I got two traders I brought on that I'm really excited about that have proprietary traded for really their entire life. One, an ex-JP Morgan energy desk trader, another guy a NYMEX market maker, and they're going to put their strategies they've used their entire lives to work here on two separate programs that we're extremely excited to launch. We go live on November 1st, and we're starting off with about somewhere between $2 and $3 million under assets under management for the launch, which is really exciting too. And then lastly, Blue Line Capital. That's my registered investment advisor. I do handle portfolios, as a wealth manager. So, I've been spending a lot of time working with clients here leading up to the election, make sure people are in the right position, given their suitability, given their long-term approach, given the expectations of added volatility into the election and uncertainty thereafter. But I do think I'll start talking into what what's happening right now. I think there's a lot of uncertainty. It's going to be removed. You know, we're going to start to see less uncertainty out there after the election. That could bring a wave of stability.
So let me ask you, you mentioned, first of all, I don't know when the hell you sleep, dude. I have no idea. Second of all, are you at your office in the city or do you live in the city? Because I just left Chicago and I haven't heard sirens since.
Yes,
and I heard sirens in the background.
Yeah, there's sirens out there. I'm in the city right now. We have an office at the Chicago Board of Trade right upstairs. I'm in here 3 times a week. I got my team in here as well. You know, most days of the week, everybody's here. And, you know, we're work is normal. You know, we're doing what we got to do. We're here for our clients on a daily basis, getting our research out, our videos out, and communicating with people. I work from home. I actually did move out of the city right before this whole pandemic. It was good timing. February 1st, I moved out to a nice town called Glen Ellen. Glen Ellen, Illinois. So I've been out there since February with my family. Love it out there. But it's a nice transition getting out of the city, especially with everything that's going on here in Chicago.
I know Glen Ellen. I used to date a girl that lived out there when I was in my 20s. She was actually a manager of a Peaches Records, which doesn't exist anymore. So I left Chicago, came down to Florida permanently. Again, good timing for me because I wanted to get out before the election, which you mentioned. So obviously we think there's going to be election uncertainty. You definitely are preparing your clients for that. Talk to me. How are you preparing your clients? Give our viewers some actionable ways to protect themselves as well, because we have a high net worth viewer. So tell us what you're looking at, what you're seeing, how you're preparing your clients.
What I come across most often are people that are too stuck in the day-to-day when they're trading their own portfolio. They don't have that holistic long-term approach. So I come across people all the time, you know, whether it be in March of this year, people that were they're 100% invested in their portfolio in equities, and they're getting a sledgehammer to their portfolio because of what was happening in March. Or right now, people that are fully out of the market and they've seen this market rally and they feel underinvested. And they don't know when to get back in, and they find themselves hoping for a sell-off to get in. So, you know, whether you find yourself on the other side of the spectrum, it doesn't have to be like that. You don't have to be all in or all out, and you don't have to be right today or tomorrow. It's about being right over the long term and a holistic approach and adding value. So it really depends, you know, how somebody is, you know, how old you are, where are you in your career, where are you with your family, where, you know, are you getting closer to retirement, are you in retirement? A lot of that really matters when you're looking into a portfolio. But if you're, say, my age and you're, you know, normally or typically aggressive on sort of that long-term retirement portfolio, and which would put into about 70% of the market when the green light is there, you do not need to have 70% of the market. But think about it this way too. Even if you were 50% invested in the market and you rode this rally up through, you know, the autumn and into this October sell-off, if you had rode this rally up to the first part of October, that 50% probably became close to 70% invested in the market. Guess what you do? You rebalance out. So if you're actively managing the portfolio, your only decisions really are, you know, rebalance out on strength, get yourself to those rebalance levels that you should be in. You have cash on the sidelines. You use that cash to buy stocks when they're weaker. And there's stocks on my watch list right now that I love to see. Marvell being one today. It's down sharply today. And you know what? I think there's going to be a good buying opportunity. There's some good support that is coming into you about $32. Other names that you just got to keep things in your watch list. CRM, Salesforce, looking for that in 230. I would love to add this stuff to portfolios. And that's what you have to do when you're talking about from the stock side. Now, trading futures is a whole different story altogether. And you want to be managing because you're trading leverage. But what I'm talking about is your portfolio. You never have to be all in. You never have to be all out. It's all about rebalancing.
Marvell, so you get, for those of you who don't know, it's Marvell Technology, symbol is MRVL, trading down about 8% right now. Bill, in terms of, so you talked about rebalancing, and this is a theory that's out there right now, is that 60-40 might be dying. It might be on life support. You do wealth management. So for the people that are used to a 60-40 split, maybe people in their 50s, prior to that, they had a 70-30 or an 80-20. That's 80% stocks, 20% bonds. When you talk about rebalancing, you talk about rebalancing into cash, or you still have the belief in your wealth management theories that bonds still provide that sort of alternative to stocks when stocks are falling? Yesterday, yields went higher, bonds fell.
In fact, first I'll start with that. How you concluded that is I do think yields are going to be higher. I think the 10-year is going to be yields are going to be higher. It's actually a position I'm taking on the future side, and it's actually encouraged me to take some different positions on the portfolio side. To get to that, on the treasuries, I've been buying put spreads in the January 138, 135 put spreads. I've had that position on for about 2 weeks, filled on those about 32 ticks, so $500 each. Those give you until the end of December. I'm actually using this rally in the 10-year futures. Again, we're buying puts on the futures as the prices go lower, yields go higher. So I'm buying puts in the futures going out to February now. When I initially put that January position on, the February contract didn't have that much liquidity, so I wanted to stick with the liquidity. Now I'm buying February's, the liquidity's there. I'm doing those same strikes. I'm working about 35 ticks, just over $500, about $550, and I might get a little more aggressive today if they come back in a bit. So I think yields rise, and a number of reasons why I think yields rise short term. Now, this is, I think, into the turn of the year, January, February. If you look at the election, 2008, 2012, 2016 elections, we've seen the treasury prices go sharply lower, yields rise after the election. And the reason being is you kind of have this holdup. We couldn't get a fiscal deal done. So they're not printing more money. They're not giving stimulus. But guess what? They're going to get that done after the election. And they're going to do infrastructure spending. They're going to print more debt. Not saying more debt's a good thing, but how can you trade it is the real question. So I think there's a great trade there. Not only that, QE1, QE2, and QE3, you go back when you've seen those, the Fed did massive quantitative easing, and guess what that did? The treasuries rallied into that. The yields were lower into that. That put a bottom in treasury yields, a top in treasury prices every time after QE1, QE2, and QE3, and we have historic stimulus measures this year. So I also looking at that as a reason for yields to rise. So again, there are a number of reasons here to look at, and then we did have a little bit of a capitulation against 50 basis points. So I'm not looking for a groundbreaking move, but 1.25% in the 10-year. And then real quickly, how have I looked into that and positioning in some of the equity markets? Regional banks. I felt I was under positioned in regional banks about 2 or 3 weeks ago, coming out of the turn of September and October. There was some strength starting to see there. I was buying some regional banks, the KRE index, adding that to portfolios. Again, I'm not taking 10% positions in the portfolio. No, I'm saying you add 1 or 1.5% to strategically or tactical positions that you like in your long-term portfolio. And you don't need to sit with those sometimes long-term. I like to look at stocks that I'm going to be fine with 5 to 10 years out. But sometimes you want to look tactically 3, 6, and 9 months out. Where can you add value in the near term?
Okay, so follow up to that then. Do you think Treasury, so you gave reasons why Treasury yields would be higher. One of those was stocks rally. One of those was more debt from infrastructure spending, et cetera. If stocks don't rally, do you still think yields are higher? In other words, is that 60-40 stock bond portfolio, is that something as a wealth manager you wouldn't necessarily recommend yet?
Well, we're not buying the 10-year. We've really thrown the 10-year in treasuries off to the side as part of that bond portfolio. So what we have used is a diverse selection of different sort of bonds. There's some municipals in there that we have, which you want to be cautious about, and some of the broader ETFs or mutual funds that can give you that exposure. You're not incurring an idiosyncratic risk, given that some municipalities may have difficulties. Another thing to add in a little bit of percentage, because again, the 10-year is at what, 75 basis points today. So right. in the 2 years lower than that. So we're trying to get yield into that fixed income side. That's really, we're using cash. We're keeping money in cash, but ultra short duration bonds is something, there's no risk there. You got to know there is risk. When the pandemic hit, those did fluctuate 7 to 10% lower. However, they came right back, but the Fed is buying corporate bonds. So I'm not saying to throw your entire 30% of your fixed income or your entire 40% of your fixed income into municipalities with a good chunk of that and then a larger chunk in short duration bonds, because there is risk there. But rather than keeping it all in cash, you can put some into that. And then as well, we like to put little bits in high yielding assets such as midstream energy. You're getting tremendous dividends there. We like to look at hard assets to couple with that, like gold as well. So we love gold for a very long time. So there is that sort of outside of stocks, there's this bucket that we look at, hard assets and fixed income, that we kind of couple in together. Hard assets are sort of just sprinkled in there a little bit to diversify. But yeah, there's a number of ways to do it. And then you still want cash because the Fed is there. The Fed's backing this market. So when the market goes lower, we find value areas, we want cash to be able to put to work. And that is why you rebalance when it rallies.
When do you still have a few minutes, right?
Yeah.
Because I want to touch on something you just said. You talked about midstream energy. Talk to people about that, because energy as a sector, when you include dividends, is down, even including dividends. But you said midstream, so that's very specific.
Yeah.
So talk about what that means.
The midstream energy, the more the logistical side, the moving side of the energy, and you're getting dividends in that. There's good ETFs that give you that avoid the idiosyncratic risk. ETFs, AMLP is one. You're getting dividends. I mean, you can't feel really secure about the amount of dividends you're getting. And I don't know what it's trading at right now in the sense of 30% dividends maybe on that price. But they haven't been cut back too much. Can you bank on all those dividends? No, but even if you're getting 20% dividends, and even before this year happened, those stocks were giving 11 to 12% dividends. So you're getting good, strong dividends. And the fact that they've been beaten down so much, I'm not very bearish on crude oil. I do think that price of crude oil is going to stabilize. If we go lower, if worst case scenario, we're going to find it back at $30 again. But I think overall, we're going to try and stabilize here. I started investing, just to touch on that too, in energy in general here over the last few months, just kind of getting my toes back in. And I like Chevron a lot, good dividends again across the energy space. If you're going to buy weakness, and you don't want to be chasing these things higher, but if you're going to buy value, buy weakness on a lot of this stuff, then you're going to, I think, have some good longer term value at these levels, looking 5 to 10 years out.
I tell you what, we've had you on the show before, Billy, but you're killing it this morning. I mean, that is a ton of information. And I want to let people know that there is a replay of this show. Billy talks fast. He's got a lot to say. He covers a lot of markets. So watch the replay if you didn't catch all that. But better yet, reach out to Bill if you need any one of his companies or just to talk to him. I know he's pretty free with his time. So Bill, where can people find you, reach you, depending on any number of things that you guys provide?
The best ways to check us out on bluelinefutures.com. That's our website. We do put a lot of research up there. There's a research tab. There's a place on there to sign up for research. You have a 2-week trial. You can pick all the reports you want, anything from what I write, the S&P and NASDAQ and crude oil and gold I focus on in the Morning Express. My partner, Oliver Slope, writes the agricultures, covers corn, wheat, and soybeans. My other partner, Philip Strebel, who's joined your show before, he does FX technical report. He does a SOFS technical report, and there's a system that he talks about in those. So there's a lot of research that you can get your hands on by signing up for a 2-week trial at bluelinefutures.com. And then if as well, you can just put your information in on the contact form there. We'd be happy to give you a call and touch base on anything, whether it's Blue Line Futures, one of our managed products, or wealth management as well. So you can reach me there.
Yeah, I know both Phil and Oliver as well. Great guys. Phil's been on the show. You got to get Ollie on the show too. Billy, before we let you go, is there anything you want to get out there pre-election that you can come back and say, I told you so post-election?
You know what? I think it's not as much who matters in the near term. I think a lot of the policy measures are really going to be implemented a year and 2 out. So I think in the near term, it's not about who, yeah, everybody's political right now, but let's throw that out the window. It's not about who wins as much as it is getting less uncertainty on the table. And I think we're going to find that through November, less uncertainty. And again, those treasury yields are going to rise out of that.
Yeah, I mean, we might have personal opinions, but that's not our job, right? Our job is to help our clients find the right way through this kind of turmoil. I'm writing a book, and when I'm done with the book, let's get on the phone. We need to do stuff together, man. We need to do more of this stuff.
Cool. I'm with you.
Billy, cheers. Thank you for being here. Thank you guys for watching. The live stream is over. Sponsored by E-Trade, sponsored by the CME Group, and brought to you by realdaily.com. Again, Jeff Killburg, CNBC contributor, Bill Baruch, CNBC contributor, Jim Iuorio, CNBC contributor, Mike Arnold, best chartist I know, Scott Bauer, Fox News contributor, Bloomberg contributor, myself, Bloomberg, Yahoo. Actually, I'm going to be on Yahoo Finance November 3rd talking about what stocks are doing as the election is actually starting to be counted. So cheers, everybody. Thanks again for being here. Thanks to the CME Group and to E-Trade and to Real Daily and to my guests whom I just mentioned. Cheers, everybody. We will see you in the next show. Watch the replay. There was a ton of information here.